On this Thursday afternoon, the major U.S. stock averages are retreating. We did get a slew of mixed U.S. economic data releases. So joining me this afternoon to weigh in on the market action is Tim Anderson, Managing Director of TJM Investments. Thank you so much for joining me today.
Well, thank you for having me.
Well, we've been seeing U.S. stock markets turn lower in today's trading session, but we have to keep in mind that we had a strong start to the month of March. We have that big U.S. jobs report coming out tomorrow. So what do you make of this action we're seeing in the final month of Q1?
Well, it's a trend the last 4 or 5 months that the market acts very well at the beginning of the month. We saw it in November, December. January, not so much. We got hit hard. But certainly even in February, the high water mark for the month was February 1. Now we're higher than that level, but we're also, the market's getting into what might be a very difficult resistance level after a pretty strong move off the lows, somewhere between 10 and 15%, depending on what average or index you might be looking at. So, the economic data the last few days was mixed, and it wasn't. Certainly today, with the factory orders being up 1.6%, the ISM services number was off a touch, following a steep decline the prior month. So those numbers weren't accelerating the trend that we had from both those numbers last month. They're kind of holding their own.
And Tim, you bring up a lot of important points because when we take a step back and look at the bigger picture, it's all about what the overall trend is. Yeah. And everyone is waiting for that U.S. jobs report that's coming out tomorrow. Depending on the numbers, what are you watching for, and will it change your Fed rate outlook at all?
That number used to be what everyone lived and died for like most of the month. And it hasn't really had a real big impact, I think, because it's come in so close to consensus now for a number of months. There might have been one or two outliers last fall. And of course, people will look at the revisions, because typically what happens with the non-farm payroll number is if you get positive revisions for the prior 2 months, that shows an upside trend. If you get negative revisions, that gives you warning that job growth might be sputtering a little bit. So the expectations are about plus 180, unless it's a real outlier, or unless there is very large revisions. You're probably, I just don't know that it's going to have the impact that the number used to have a couple of years ago. And of course, people will look at the participation rate, because it's been running now for a couple of years at a much lower level than people would really like to see.
And I think we also need to keep in mind, on top of the direction of the equity averages, is trading volume, because when there have been up days this week, we've been seeing lower volume than when the trend tends to be lower. So we'll keep an eye on what happens tomorrow morning. But looking ahead to next week, we get several central bank announcements, including the ECB, BOC, RBNZ. But I'm sure you'll be paying attention to the Eurozone, and that will be coming out, the ECB decision will be coming out after those GDP figures. And also on top, we have the Chinese inflation. So what do you think is important for investors?
Well, I think that the ECB will be very important, because there's a controversy over the negative interest rates and the implications thereof, and you can see it in the it's not the only factor that's contributing to the weakness in the European banks, but it's definitely one of the leading factors.
And before I let you go, we've been seeing wild swings in oil prices all week, as well as in the previous month, as well as all quarter. So going forward, do you expect to really see anything happen in terms of this supply glut?
The oil is a big topic also for the market, because I think that just the fact that oil now has held 30 for the last couple of weeks, and even if it would just sit here and not have a lot of movement, that would help the market, because I think the market was very concerned about what the collateral damage would be if oil went through 30 on the downside and went down into the mid-20s and couldn't recover from that level. We went down below 30 a couple of times. The market got very, very nervous about it. So just holding 30 without rallying was going to help the market stabilize and move off those lows from mid-February. Now that it's inched up 33, 34, I think it'll help give the market a little bit of stability. But I think the people that are talking about oil easily getting back into the mid-50s, the second half of the year, I'm a little, we're a long way from that.